that is the second bell, which means class is in session here. Thank you for joining us at this week's episode of the Apartment Academy, the multifamily industry's only operations-focused podcast and your institute of higher NOI. I'm your host, the Dean of the Apartment Academy, Daniel Cunningham, and today's guest lecturer is Michael Warner. Michael is the principal of Pacific Southwest Real Estate Services, which is a broker that has a particular focus on providing multifamily financing through life insurance companies. And his perspective on what's happening in the industry and how life insurance is becoming a better and better choice for those looking to finance their multifamily deals is pretty timely. So give a listen and I think you'll learn something. Here he is. Welcome, Professor Warner, to the hallowed halls of the Apartment Academy. It's great to have you here.
Thank you for having me. Thank you for calling me professor.
We actually had on two occasions people with actual PhDs on the call, and they were like, yeah, it's okay, yeah. So Michael, you have been servicing the multifamily industry from the finance side for a number of years. Can you just talk a little bit about your background, how you sort of came into the industry so that folks have context about your expertise in this matter?
Certainly. Right out of college, I worked for Wells Fargo Bank, and then eventually I moved to Bank of America. And I saw enough deals at both those institutions that didn't get done, but in my heart and soul were great deals. And I just realized I was working within a tight credit box at the two money center banks. And I lost a deal to a mortgage banker. And it was a parking lot by LAX. And I thought this thing's going to print money. But B of A in their mind didn't want to do the deal. I ended up going to work for that mortgage banker and then became a partner. And so that's how I got into mortgage banking in 2002.
Well, it is certainly an interesting time to be in mortgage banking and commercial real estate related mortgage banking. That's for sure, with what the Fed has been doing with rates, and everyone's talking about all this debt that's maturing and the axe that's hanging over the necks of the collective real estate market. Talk to us a little bit about that. Like, what is happening right now at this moment? This is 2nd of October, 2023. What do the markets look like right now? Explain a little bit about what's happened, like why the Fed interest rates have had this sort of cascading effect on those loans that are maybe were short-term or maturing or were bridge loans, and where that leaves us right now, this moment in time.
Well, interesting enough, yes, there is a ton of debt maturing, but I think it's overstated in some ways. A lot of our clients came to us 2-3 years ago and took the heavy hit on the yield maintenance costs and refinanced. When they saw rates in the threes, mid threes, they're like, well, heck, they can't get any lower than this. You know, a treasury's trading at 1.25%, the 10-year I'm referring to. And here we are having lunch with them later, and they're just, I can't believe I did that. Thank you so much for talking us into paying $800,000 in prepayment premiums, because look where we are today. And they've got another 7-8 years of fixed rate financing in the threes. So that's been a good feeling. But the effect of the Fed and their policies has just, it's been difficult. From talking to borrowers, it's almost like having a counseling session, trying them to understand that we're not in the 3.5% interest rate or the 4% rate world anymore. And the reality is 6 3/4 and 6.5 is kind of the going rate from Fannie and Freddie and even the life insurance companies. I mean, our most aggressive lenders are probably 160 over for apartment financing, which is really competitive with Fannie and Freddie. But the net effect of that is some deals just don't work. You see these purchase transactions, the caps in many markets, especially the market we're in Southern California, they haven't capitulated yet. There still needs to be some price adjustments. And so you get buyers looking to put an X amount of equity in, and they're not getting the numbers they need because of the underwriting. And, one other thing on underwriting, oh, by the way, the underwriters are way more conservative because of the insurance costs, for one, and the payroll costs for others. Taxes are taxes. So these are all things that are rolling into getting a loan that, guys are thinking I'm going to put 25-30% down, and it's really 40-45. So that's difficult. So there's a lot of handle.
Why have the equity requirements gone up? Not just interest rates.
So it doesn't pencil. You're shooting for a 120 NOI or a 125, or if it's a CM1 insurance loan, a 150 NOI.
Oh, there's a lot of lingo.
Oh, sorry.
You got to help us out, Michael. What are we talking about here?
The professor needs to digress.
Yeah, these are students here in the classroom. This is not AP. This is 101.
When I talk about NOI, that's the net operating income after all the expenses are taken out, and those operating expenses are underwritten expenses as opposed to what actual are. So we're going to take out some carve outs per unit for capital expenditures. We are going to mark the market to vacancy, a minimum 5%, mostly, or what the actual is in the market. These are things that need to be supported by appraisal. And we get down to a 120 coverage, which is 1.20 times. We need that coverage to make our loan, and
which is to say you need 1.2 times the debt payments in NOI in order to qualify.
Correct, 1,200 over 1,000, easily explained. And so, and many lenders in the bank space are 125. And if you want a life insurance company to give you a long-term commitment, we're talking longer than 10 years, and we're probably going to be sub 60% at a 150 cover. Not to say that they won't do a 130, but if you want their very best pricing, we call it a CM1, and that's a 150 cover. And don't ask me what CM stands for. The professor forgot that one.
All right, so with higher interest rates, it becomes a requirement to essentially put more equity into the acquisition, because you are paying more for debt, and so your NOI has to go up commensurately. If you can't raise NOI, actually, I guess you're constrained by NOI, and the interest rates are going up, then you simply have to put more equity in so that your debt payments come down and fit their criteria.
Sure, on the in-place NOI, I mean, there is obviously, there's been a ton of transactions, but the ones that are happening is there's some value add that's going on. And there's bridge lenders in that space that recognize, hey, if you put $10,000 to $25,000 per unit into this individual property, you'll take it from a C plus to a B minus, and the rents in the market are B plus or B minus to B plus. And so there's a lot of bridge lenders out there, debt funds and banks to some degree, and little did people know there's insurance companies that do that type of business as well. But we're still underwriting to that exit of the 120, 125 debt cover.
So you still have lenders willing to buy into the value add thesis, where you're going in debt service coverage ratio may not be the 1.2, but you're coming out of the rehab ratios meet that. They will underwrite to that still.
Oh, certainly. I just think that the deals that were done 3 years ago, as they're exiting into stabilization, they're not penciling at the takeout. So finding that permanent lender to do that deal is tough, because, as I mentioned earlier, the higher expense levels that are being underwritten to, and then the higher interest rate. I mean, that essentially, let's call that a 2.5% increase in interest rates, crushing NOI.
Have any lenders actually just exited the market, or is everybody they're just raising rates and causing all of these other havoc?
Famously, we've seen in the news the banks that have had some issues, and I don't want to go through each individual name, but yeah, the banks in general are somewhat out of the market. And I talk to bankers daily, and many of my old compatriots at the big banks are kind of just babysitting their portfolio and talking to their existing clients about, hey, your covenants, let's have a conversation about what's going on with your property. And so those are real conversations. And then the banks that are active, they realize it's an opportunity, and hey, we'll make you a loan, but listen, I need 10 to upward to 30% of the loan amount on deposit with our institution. Okay. If I needed to do that, why do I get a loan?
Well, that brings us to your particular area of practice, actually, which offers maybe to some an unknown alternative to your traditional Fannie, Freddie, or bank lenders, and that is, as you mentioned earlier, life insurance companies. What is it that's different about the process with life insurance? What are they looking at? How do they lend? Educate us a little bit about how that might be different than what people think of as a loan through like a large lender.
Yeah, certainly. I think the most important thing to recognize is we're not going to be the proceeds leader for most deals, on acquisition, certainly. But we are a very viable and reliable source of capital. Intermediaries, mortgage bankers like myself that represent, in our case, 30 different life insurance companies, and we service $6.6 billion of their debt in across all the food groups, multifamily, obviously, but retail, industrial, and the whatnot. We provide a real upfront assessment of the cash flow, the valuation, before we even take it to our lenders. So unlike the bank that's going to take your application and then do their due diligence and then render you an approval, we can have a commitment within a week or two based on our due diligence up front. We can lock interest rates up front. So those borrowers that are concerned about the continuing and possible raising of their interest rates as we go forward into 2024, we can provide a certainty of what your rate's going to be at close a week into the project. We can also forward lock your rate. Let's say you have a maturing loan in 18 months and you still have prepayment language you're under and you do not want to pay hundreds of thousands of dollars in yield maintenance or defeasance costs. We can provide, up to a year. I wouldn't say that's going to happen a lot, but at least 6 months of forward rate commitment today. So that's something that's unique in the market that many banks, I don't think any banks would make that claim they could do.
And is there any trade-off in terms of, going this direction, Michael? Is there a downside to going this route, or what's maybe more difficult about the application process or the acceptance process? Why aren't more people aware and going this route?
I think the obvious downside, if you want to call it that, is you're probably not going to get the proceeds on a purchase or the cash out on a voluntary refinance, and specifically talking multifamily, than you would get with Fannie or Freddie. We certainly can meet the rates. We could beat the rates. 160 over the Treasury today, and I should have wrote this down. Well, I did write this down. What is the rate today? We just closed a deal with one of our insurance companies, a $30 million loan, fixed for 10 years at 6.35%. That's a 160 over, and it was 10 years IO, interest only. So we can meet or beat Fannie and Freddie. I think we're an easier process than doing an agency loan, and some borrowers just aren't agency lenders, our borrowers. And our servicing's local. So we service locally here in San Diego. We're not on the East Coast for you West Coast borrowers, so that's certainly an advantage. But I'd say the disadvantage is probably going to be proceeds. If you're a proceeds-driven borrower, we're going to lay up short 9 times out of 10, I would say.
Is there, limitations on product type, vintage, anything along those lines that affordable that play into these decisions?
Going forward in 2024, my understanding is the agency lenders, Fannie and Freddie, they are going to be really focused on their mission-driven business, which is affordable. And so your apartment, multifamily, they should have to get the best pricing and to get the best look, an affordable piece to the building is going to be necessary. Not to say that they're not going to do others, but Class A type stuff. So that's kind of the Class B, B minus, 80s to 90s vintage properties. Life insurance companies are going to probably want to be in that competitive rate market. We'd want to be B plus or higher, maybe a B in a good market. Our smaller life insurance companies, the Symetras, the Standards, Ohio National, Farm Bureau, the $5 million and up deals up to $15 million. We certainly can look at B minus, C plus properties, and would love to see that business. And we do a lot of that, garden style walk up, no elevator service type properties.
And all product types, the construction, bridge, permanent financing, all of those are available through life insurance?
Yeah, interesting enough, I don't think people think often about a life insurance company as your construction lender. In construction to perm is something that we can present. The other really interesting product that I don't think anybody, I wouldn't say anybody, but is, you got a developer, he's known in the market, and we can do this for all property types, not just multifamily. You have a developer that's used to raising friends and family money, preferred equity investors that are going to get a 13 to 18% return. We have a program through one of our life insurance company called participating debt. And essentially, the developer has an institutional partner in their ground up or value add multifamily project. And so you're not beholding to a gentleman that's given you a couple $1 million and he wants a certain color paint. Our lender isn't interested in that. They've already vetted the developer. They're really interested on what's their return on sale. And it's not a buy and hold transaction. They are going to be co-invested with you, and the returns are 60-40 or 65-35, the bigger number going to the developer. And there's other benefits as well. The developer gets all the depreciation. Developer gets the insurance write-off at a higher cost because of the investment by the insurance company. Those are questions for your CPA, but they are significant.
Mike, was there a time horizon that if they're looking for a return, like how patient will they be for that return?
Typically it's 4.5 years. So you've got plenty of time to build, stabilize, and market. And we're really looking for regional or institutional buyer type of transactions. We'll go down as low as $10 million, up towards to $50 million for those projects. But we're not looking to sell as a John Q. public purchase. We're really looking for a developer that's got the eye on the regional or institutional purchaser. And so then we get the highest return.
Can you elaborate on that a little bit? Does that mean, like you mentioned earlier, they've vetted the developer already? Does that mean there are some criteria the developer needs to have a history of successful development? They have to have certain.
Yeah, I think the resume, the sponsorship is going to be first and foremost. The market is somewhat important. It's not to say that we wouldn't go to a smaller market, but if it's a understood and a market that needs housing, we've gone to smaller markets. That's not an issue. I think generally if it's got 75 units or more in the project and our average is 140 to 160, somewhere around there, then we're interested. If it's below 75 units, it's too much minutia, and it's just not enough, on a sales basis for the returns they're looking for.
Got it. Okay, so it's definitely an institutional class product.
Yeah, in many ways, but again, not just multifamily. We do big box anchored retail and all in industrial as well. So that goes across the board in terms of all property types for that program.
And just so I got this right, you swap out a preferred return, and instead you have a split of proceeds from sale, 65-35. You mentioned.
Yeah, and the biggest benefit is you're borrowing at 5 3/4 fixed for 4.5 years on an IO basis, interest only basis. So really, the debt's a loss leader. That's you go to a bank today, you're getting a prime plus deal, which prime's what, 8.5. So you're in the 9s for a construction loan, interest only.
That sounds interesting. I've never heard of that. Is this super niche-y? Is it new? Is it just something people don't know about?
No, I wouldn't call it niche-y. It's pretty popular with our company. Matter of fact, this is the perfect market for it when there's disruption. When you have banks on the sidelines or the cost of construction, borrowing is such that the lender is offering 8.5, 9.5, 10 kind of interest rates, and you've got to raise money. Well, if it's a project where the developer has the equity, and we're talking 15 to 20%, and they'd rather just have an institutional partner and fix that rate at 5.75 versus floating it in an uncertain market in terms of rates. This is a perfect time for this product. We could finance, I say 95 to 100% of the cost. Let's just say 85% is, generally the loan to cost. And we got to exit. The underwriting is such that you can back into your loan amount pretty easily as long as you can do a little bit of math. You know, 25-year amortization, a 120 cover, at 5.75. That's for a $10 million loan. That's $850,000 in NOI. And a $50 million loan, I think I did the math because I think that's probably like what 4 or 5 in NOI on those numbers. So those are the two brackets, 10 to 50.
Where do you think the market's heading right now? Are there any indicators that lending will start to loosen up anytime soon, or do you think we're in this market for some time, 18 months, 24 months?
Well, the professor does not have the crystal ball, Daniel.
Oh, that's what we were hoping for. I thought in my notes here that you brought a crystal ball.
um, I do think it's going to loosen. I think there's also going to be some price capitulation. I think the feeling of looking back and saying, well, I'm only going to get a 5-year loan or a 3-year loan if it's available fixed because the rates are coming down. I think the borrowers, at least the really experienced borrowers that have seen markets, and I've been doing this since '92, are thinking, I don't know if this is changing in the short term. So the reality is, if you are an individual developer or you're an owner, your attitude's very different than, let's say, a syndicator. Whereas a syndicator is playing with other people's money to do deals. They're looking at it differently. I think the long-term hold borrowers, family offices, they're looking at, this rate in the 6s historically isn't that bad. And so you've got syndicators that will buy down rates by paying extra points. What do they care? It's not their money. And they'll look like geniuses to their investors. But there's a cost for that. So I think those are two different camps. They're looking at the interest rate market. I think that the seasoned investors are realizing this is maybe not a short-term blip.
Yeah. Is this market inducing more life insurance companies to get into offering products like this, or do you already have pretty decent penetration, or people retracting? I mean, how are life insurance companies reacting to this market?
I think they're doing what they do, which is awesome, and it's one of the best things of being a representative of them. They're just consistent. They're very consistent. You know what you're going to get. It's very predictable, and so from a life insurance standpoint, their only issue this year is everybody wanted short-term debt in the very beginning, the second quarter, 23, and so that debt went away for us to be able to provide it. A few of them have it left, and sparingly for the best deals or the right sponsors. And if you are looking for a life insurance loan in particular right now, you're probably looking at a 2024 funding in the next, if you're not applying in the next 15 to 20 days, we're probably not closing until 2024. Just because how much money came into the life company world because of the banks being unattainable in some cases.
Interesting. Well, if Michael, people want to just explore this with you, find out more, how would they get in touch with you?
I'm happy to talk you to anybody. This market is very up and down. I'm happy to give any kind of advice or insight that I can provide. I may be a professor, but I'm not all-knowing. So I love to hear other people's ideas as well. So if you'd like to reach out with an email, mwarner, WARNER, @psrs.com, feel free. That's probably the best way to get hold of me, and then we could schedule time to talk.
Awesome. That sounds great. Well, I appreciate you coming on and talking about this financing instrument. It's very interesting. I'm sure for a lot of folks, really timely information as well. So it's been great to have you on, Michael. Thank you.
Thanks, Daniel. Have a great day.
Thank you for joining us at this week's episode of the Apartment Academy podcast. The Apartment Academy is a production of Leonardo 24/7, the industry's leader in multifamily operations and maintenance software. At Apartment Academy, we realize the hard work that goes into property management and the stress that comes along with it. Leonardo 24/7 takes the guesswork out of your team's day-to-day by providing customized daily guidance on tasks that need to be done, guaranteeing consistent operations across your entire portfolio. To learn more, visit www.leonardo247.com today.